Have you ever noticed how the stock market seems perfectly comfortable ignoring reality? The economy is struggling, businesses are closing, yet the S&P 500 is hitting all-time highs. Then, just when the news sounds undeniably optimistic, the market craters. It feels illogical. But the truth is, most everyday investors are looking at the wrong scoreboard. They base their decisions on daily headlines, quarterly earnings reports, and whatever emotional narrative happens to be trending. None of those things actually move markets. A positive press release cannot physically push a stock price up. Raw buying power does. That buying power is dictated by a massive, unseen engine operating beneath the surface of the global economy, the Global Liquidity Cycle. It controls the ebb and flow of money, and by extension, the rise and fall of financial markets. Once you understand how this hidden flow of capital actually works, you stop reacting to market surprises and start anticipating them before they happen. To track that flow, we have to start at the very top of the financial system. The ultimate source of all systemic liquidity is the central bank. This diagram shows how central banks build the foundation of the money supply. They create what we call base money, a stockpile of digital reserves generated directly from the central bank balance sheet. But you and I can't pay our rent or buy groceries with base money. It operates in a closed circuit. It's a specialized currency used exclusively by commercial banks to settle accounts with one another. The money we actually interact with is called broad money. These are the funds sitting in your personal checking account, or the cash a corporation uses to meet payroll. It's the spendable purchasing power moving through the real economy. Tracking the exact moment that locked-away base money transforms into broad money reveals when a flood of capital is about to enter the real world. This flowchart maps that transmission. Step 1 begins when the central bank expands its balance sheet and injects massive amounts of base money into the commercial banking system. Armed with these new reserves, commercial banks gain the regulatory clearance and the confidence to issue new loans to the public. This triggers the core mechanic of the system. Loans create deposits. The act of a bank issuing a mortgage or a business loan literally generates brand new broad money, multiplying the initial central bank injection into a much larger pool of capital. Once this wave of new purchasing power is created, where does it all go? This surplus liquidity aggressively hunts for yield, bypassing the consumer economy to flood directly into financial assets like stocks and real estate. In this system, liquidity provides the fuel for asset prices. Most major market bull runs are a mechanical symptom of excess money creation, often independent of underlying corporate success. That pipeline of money is not a permanent one-way stream. It is a highly reactive, closed-loop cycle. The cycle begins with expansion. Central banks use quantitative easing to flood reserves, driving asset prices to a peak. But policy is reactive. To cool the economy, they trigger a contraction, draining reserves. Prices fall until hitting the trough, restarting the loop. Because policy is constantly reacting to economic conditions, market booms and busts are structurally inevitable. The stock market is trapped in a perpetual pendulum of expanding and contracting liquidity. This brings us to a foundational rule of the logic macro framework: liquidity leads and growth follows. Compare that reality to the average investor, who is still frantically trading based on lagging economic indicators and daily news noise. An institutional macro strategist ignores those headlines. Instead, they monitor the leading indicators: central bank balance sheets and commercial bank reserves. They recognize that whether the market is in a risk-on frenzy or a risk-off panic, those environments are merely downstream symptoms of the current liquidity level. By tracking the global liquidity cycle instead of the news, you transition from reacting to market narratives to positioning yourself ahead of them.